How does arbitrage trading works? And is it the same as spread trading or pairs trading? In this video, I'll explain to you this concept and I'll show you some examples on how to build strategies around this concept. So let's jump in. Hello everyone, my name is Ali Casey and thank you for joining me on StatOasis channel, where we discuss finance, algorithmic trading, investing, and everything else in between. If you are new to this channel, make sure to subscribe, hit the notification bell so you don't miss any of the great videos that I post daily on this channel. Also, if you are getting any values out of this video, it would really help me if you can smash the like button and share the video with others, as this will help me grow this channel. So a simple definition of pairs trading is basically matching a long position with a short position in two highly correlated instruments. So there are many terms to this concept. You can call it arbitrage because you're arbitraging between two similar instruments, or you can call it pairs trading because again they are paired, so they tend to move together, or it's called spread trading because you're actually trading the spread between these two highly correlated instruments. Also sometimes it's called market neutral strategy because basically you are long one and short the other. So basically you're neutral and you're just capturing the spread between these two instruments. So here is a simple graphic to show you what I mean. Imagine you have two instruments A and B. If these instruments are highly correlated, so they tend to move together. But of course, sometimes due to news, supply and demand, whatever the case is, sometimes they diverge. And when they diverge, for example here, at this point, then we can short the one that's making most money and we can long the one that is making less money, because we expect that they tend to converge again to the mean. So the key to the concept is to find highly correlated instruments, and they don't have to be stocks. They can be futures, and you can trade them with options. It could be an ETF, an index. We just need to find highly correlated instruments, and then we can trade them in many different ways. And all those ways can be summed up in trying to capture the difference when they diverge. So once they diverge, we can short and long, and we capture that divergence. So this is the chart for Pepsi Cola company. And of course, as everybody knows, Pepsi Cola is the competitor of Coca Cola. And here the candle charts are Pepsi Cola and the bar chart is Coca Cola. And we can see that most of the time they move together. Although if you plot it like this, it could be hard to see. I mean, we know they are both exactly the same, highly competitive, and they rarely diverge, but you know, they tend to diverge and converge. So another way to plot this difference, so this yellow line is the plot of Pepsi Cola divided by Coca Cola. And for example, this is a 1 year plot, and we can see now that Pepsi Cola is outperforming Coca Cola by 5.16%. So it doesn't matter if both of them are down or both of them are up. We are measuring here the performance of Pepsi versus Coca Cola. So how can we trade this outperformance? Let me show you the first way to do it. So if I plot the Bollinger Bands on Pepsi Cola and Coca Cola, this is now the plot of the candlesticks of Pepsi and the bar chart of Coke, and then both of them as a ratio, Pepsi Cola divided by Coca Cola, and we plotted the Bollinger Bands on this ratio. So we expect this ratio to always come back to the mean, which is the middle line. So if I take this example here, so let's say when they close below the Bollinger Bands, we expect them to go back to the mean. So if I want to trade them here, then I will go long Pepsi and short Coca-Cola. And let's see what we get. So let's say here on the open, I will go long Pepsi, and we will exit at this bar when it reaches the middle, which is the median, and we made 2.44%. And then if I measure Coke at the same time, so we are trading again the open, so again we are shorting the open here and long Coca-Cola, and we lose almost 1%. So Pepsi long made 2.4%, and let's say Coca-Cola lost 1%, so we made 1.4%. So how this trade will happen, you need to divide your amount of money equally. You cannot trade by number of shares because most likely the prices are different. So since we are making in percentage and we're expecting the instruments to converge back to the mean, we need to trade the same amount of money. In stocks, that would be really easy. For example, we have $10,000. We divide it equally, $5,000 each. And then we divide $5,000 by the number of shares and we get that number of shares. So when we make the percentage, we're making the same percentage on the total amount of dollars. So to put that in numbers here, the open for Pepsi, we divide $5,000 by 154 and we get 32 shares. So we go long 32 shares of Pepsi. And at the same date, Coca Cola is 56.84. So we divide 5,000 divided by 56.84 and we get 87 shares. So we go long 32 shares of Pepsi and we short 87 shares of Coca Cola. And that would be the trade for this pair. Now, if this concept is a little bit hard to get, or even if it's easy, I can show you an easier way to grasp this concept. So if you get the price for Canadian dollars and US dollars, so currently the US dollar is 1.24 Canadian dollars. And if we get the price for US dollar and Australian dollar, so that would be 1.35. And Canadian dollar and Australian dollar are highly correlated. So if we can get this ratio, this would be what? This would be the Canadian dollar, Aussie dollar. So currently the price is 1.0899. And of course, this comes from their ratio with the US dollar. So the US dollar is the constant between them. So if I divide 1.35, which is Aussie and US, divided by 1.24, which is Loonie and US, we get 1.0887, which is very close to this number. So this is how this ratio arrived here. Of course, if you are a Forex trader, you already know this. This is an easy concept to grasp. But for people who don't trade Forex, really, this is what Forex is about. You're trading a pair. You are long one currency and short the other currency. That's what you're doing every time you're trading one pair. You're always long one and short the other. That's always the case. So for Forex traders, just bring that concept to stocks or futures or ETFs or indexes or whatever. You're trading just a pair, but instead of just of random pairs, you're trying to find highly correlated pairs to trade. Why highly correlated? Because highly correlated pairs, they tend to converge back to the mean, and that's what you want. And in that case, then you want to trade mean reversion strategy on this pair. An easy way to find highly correlated stocks, of course, there are a million ways to calculate it, but I'll show you a website that you can do that for ETFs or stocks. So this is Portfolio Visualizer, and you can run a correlation. So I put these liquid ETFs and just run a correlations on them. And if I do Control F and just type 0.9, so this will highlight the 90 plus correlation. So we can see that the SPY is highly correlated with triple Q, which is the Nasdaq, IWM, the Russell, EFA, and XLI. So in fact, I can run the mean reversion strategy on these pairs profitably because they are highly correlated. So let's try this, SPY with XLI. So this is a weekly plot of the SPY and XLI with a Bollinger Band, and we can see they always revert back to the mean until they don't here, and then they go back to the mean again. So now we are looking at the spread between NVIDIA and AMD, and we can see NVIDIA is outperforming AMD by a lot. And if I switch them off, we can look at the spread. So this is the spread. And NVIDIA at 2018 was at the peak where it's outperforming AMD by a lot, and it came down since 2018. Now there is another way to trade other than mean reversion. So let me switch this one off. So once you have this spread as a one plot, just like a currency, well, now any strategy can work on it other than mean reversion. So you can do trend following, you can do breakouts. That's why I brought the concept of pair of currencies, because you're building strategies on currency pairs, so same thing can be applied here. It's just now you need to find how to get this data inside your trading platform, because usually it's not available. Usually Nvidia prices separately from AMD price. But in most platforms you can get this by dividing the price of one over the other, or deducting the close price from one of the other, and then you're building your own data, and then you can trade it. Of course, in StrategyQuant X, you can just export this data and import it in as a new instrument, and then you can build strategies on it just like any other strategies using your building blocks. So I hope this video opened your eyes to a new way to trade normal instruments like stocks and futures and ETFs. Of course, as usual, if you have any questions, any comments, please do so below the video and I'll be more than happy to answer you. Of course, if you want to take this further, then you are most welcome to join our Discord server through the Patreon link down below, where I host live weekly questions and answers alongside the tactical asset allocation portfolio signals, the stock portfolio signals, and of course all the free code download in the server. As always, good luck with your trading, good luck with your investing, stay safe, and I'll see you soon.